Are apartments a recession-proof investment? I'm Jason Kish. I'm in the commercial real estate investing space, and we're going to explore what actually happens to multifamily real estate during recessions. Let's start off by talking about what a recession actually is. Well, the most strict definition is 2 consecutive quarters of negative gross domestic product growth. But the primary hallmark really is the broad loss of asset and stock values. In simple terms, when you're seeing those things in a really broad way across the economy, that usually is what people are referring to when they talk about a recession. Recessions can vary in length, but US recessions have averaged about 11 months since World War II. They've been caused by things like pandemics, wars, asset bubbles, or aggressive interest rate hikes. You can see it's all over the place what can actually spark a recession. The worst thing about recessions is that as individuals experience job loss and wage cuts, it comes at just the wrong time because their portfolio takes a hit, their stock prices go down, and now if they need to dig into their 401k or into their stock portfolio, they'll pull that money out after those losses have already been locked in. So let's see just how big some of the last recessions were. I charted out the last 5. You can see there were some pretty big ones. So we'll start from the 80s and work our way up. In 1981 to 82, we had a decline of 27%. We had a more mild recession that really some people would barely call a recession in the early 90s. And the stock market fell about 20%. By stock market, I'm measuring it with the S&P 500 because that probably is the way that most people measure the stock market broadly. 2001 to 2002, this was a big tech bubble burst. So the NASDAQ, which has the tech firms in it, the NASDAQ fell by even more than this, but the S&P 500 fell by 49%. Even great companies, and what would turn out to be future great companies like Amazon, people were wondering if those companies would even make it through it. Now, the biggest recession that we've seen in my lifetime is the Great Recession. The S&P 500 went down 57 points. Homeowners lost their houses. There was widespread loss of jobs. So this was a really, really rough one to go through. And now the shortest one happened in 2020. We went down 34% very quickly and it bounced right back. It was almost like it didn't happen as of a few months later. So that's a really interesting, different one. So we talked about the stock market and how it performed during the most recent recessions. It's not a pretty picture. It went down anywhere from 20% to 57%. What I'd like to look at now is the rental vacancy rate in the United States. And this is provided by Fred, which is the St. Louis Federal Reserve. And these gray bars, these are recessions. So during the Great Recession that I was talking about, where stocks lost 57% of their value, the vacancy rate went from 10.1% up to 11.1%. And it just falls off a cliff from there. And during that really short recession in 2020, vacancy rates actually dropped really quickly. That was interesting because the government was actually paying for people to keep living their lives essentially. So they didn't need to leave their apartment at any point. Let's dig back a little further into the dot-com bust. We went from 8.3% up to 9.1%. And then you do immediately have a drop. It's really interesting as I'm looking through these that the vacancy goes up and then it seems to either settle or drop directly as soon as the recession is over. Vacancy rates aren't the only thing that matters for multifamily housing investors. Let's dig back into the Great Recession where I showed you that stocks dropped 57%. CB Richard Ellis has a really interesting article about how multifamily real estate did during that time and then how it recovered out of it. The influences on Class A performance included the relatively high level of construction and deep job losses leading to some residents of Class A assets moving down to Class B. Class C assets experienced more credit loss, and that means residents not paying rent and breaking lease contracts largely due to job losses. When you look at this chart, you can see that Class A, like they were just talking about there, Class A goes from a revenue growth year over year from about 5%, and it drops all the way down to, it looks like negative 11%, and then it pops back a couple years after the recession, or after the low point of the recession. Class C, it was a little less profitable coming in. Remember, this is measuring the revenue. So the year-over-year revenue growth, which was 3% leading into the recession, and it went negative, almost to -9, and it took a little bit longer to bounce back. And Class B, that was in a little bit more of a Goldilocks position where people from Class A, they didn't want to pay that premium price anymore because they maybe lost their job or had to take a different job or had their wages or hours cut, so they needed to move down. But in Class C, they were taking those credit losses, meaning that people weren't actually paying their bills and they were probably being evicted. So you see that Class B, it actually fared the best. And we were up to a point where Class B was, at the beginning of the recession, it was experiencing year-over-year growth of about 5%. It dipped really quickly down to about 7%. And it bounced back to even more profitable levels within about a year of taking that major dip. So you can see that during a really, really big recession that's happened in our somewhat recent history, it's almost 20 years ago, but we'll call it recent history, that multifamily real estate revenues did drop, but compared to the stock market, it's a night and day difference. The other thing that I wanted to bring up related to this is that it took about a year for the profitability to bounce back to where it was before, where with the stock market, you can see here, the low point came in 2009. And to get back to where, and we're not talking about, you make cash flow on those multifamily properties while the year over year values are down, but we're talking about just getting your money back in the stock market during a recession. So from 2009, it took all the way till, let's see here, about 2013 just to match the levels of 2007. So when you net this all out from 2007 to 2013, you would have seen $0 growth in your investment portfolio, just measuring with stocks. So it does look like multifamily is impacted by recessions. Now, we just had more data on that really, really large recession that we experienced 18 or so years ago. But the impact on other recessions is either non-existent or much milder than what we see in stocks. And I think that this chart by Co-Investing Club does a great job at summarizing the typical performance of different assets during recessions. Stocks, we'll just start with that because that is really the most volatile during a recession. Now, stocks, the S&P 500, it has great long-term performance. We're just talking about recessions right now. And stocks, unfortunately, their volatility, as you can see on this, is very high, but it tends to recover somewhat quickly during recessions. The Great Recession did take a little bit longer. Residential real estate, it says that its performance during a recession is a slight decline to stable, volatility low. That matches up with what we were seeing on the CB Richard Ellis graph, and it matches up with what we were seeing for the vacancies from Fred. Now, where could you put your money to actually make money in a recession? Well, bonds actually go up in value. If you're holding bonds in a good time and then times get worse, usually bonds actually do better in recessions than they do in the good times. The other thing that you can do is you can sit on cash or have money in a money market. But if you're just sitting on cash and that recession doesn't come, that's not going to put you into a great situation. There's one other thing that we really didn't talk about, and that's gold. Gold can be fantastic during some recessions, and it goes way up, like I'm talking explosively up. But in other recessions, gold actually goes down during the worst of the recession. What we know doesn't do well during recessions is stocks. We can see that it's really glaring. You have to be able to hold those stocks through the recessions. How does multifamily real estate hold up? Well, it turns out that it's not quite the stronghold that cash is during a recession, and it doesn't have the liquidity that cash has either. That's the other thing that you need to keep in mind during a recession. A properly managed multifamily real estate asset, it gives great returns during the good times, and it beats stocks handily during recessions. So I hope that you found this investigation valuable. I'd love to hear what you think about it in the comments, so please comment below. Please like and subscribe because it helps the channel immensely. Thanks for watching, and I hope to see you on the next one.